Hello and welcome to Volatility 411. I'm Joe Teague. Welcome to the roller coaster that is volatility, specifically VIX trading. We've seen over the last week. On Friday, the VIX was at 22. We had a big sell-off on Friday that started with a weak jobs number. Jobs for July came in very light. People started pricing in more rate cuts with a weakening economy, maybe 50 basis points in September, maybe another 50 in November. So people are expecting the economy to be weak, the Fed to be very accommodative, and this really exacerbating selling over the weekend on Monday because there was a carry trade where people were holding Japanese currency versus the U.S. currency, and Japanese are expected to be raising rates on their central bank. Our central bank is lowering rates. That's led for a lot of traders needing to unwind positions very quickly, which led to just a rout in the market, loss of liquidity, a lot of selling pressure happening all at once, and that led the VIX to be 64 before the open on Monday. What an amazing overnight market we saw on Monday, and that's all been unwound in the last 2 days. The market's rallied back to where we were on Friday, and the VIX has come back all the way down to 22 where we were on Friday. So just a tremendous amount of volatility in the volatility, to say the least. Now, for me, it's going to come back to the economy. Maybe some of that currency crisis has been spared, but back to the economy. We need to stabilize this economy. If we have a soft landing, maybe these stocks will be okay. But if we continue to see more jobs weakness like we saw in July, we might be in for a rough spot in these stocks. Remember, we have higher than normal PE ratios. There's going to be a double whammy of earnings don't come to expectations, and we need to take those PE ratios down. We could see potentially a lot more selling in the market. I'm Joe Teague. This is Volatility 411.